Do you crave worthless paper Bitcoin? With the emergence of Bitcoin ETFs, you might soon have the opportunity to invest in something as dubious as the US dollar. Recent months have witnessed a surge in traditional financial interest in cryptocurrency-based exchange-traded funds, ETFs. Following a hiccup in its initial filing, BlackRock resubmitted its application for a Bitcoin ETF on July 3. A week prior, Fidelity led a group of investment firms in submitting applications for Bitcoin-based ETFs to the Securities and Exchange Commission, SEC. Meanwhile, HSBC has become the first bank to offer Bitcoin, BTC, and Ether, ETH, ETFs to customers in Hong Kong, with BTC currently over $26,000 and ETH over $1,600. In the realm of Bitcoin, it's often the seemingly positive news that poses long-term risks, while short-term negative news can reinforce the case for Bitcoin. A prime example of the latter is the 2017 block size war, when the Bitcoin community divided into the big block camp, resulting in the Bitcoin Cash fork, and the small block camp, implementing the segregated witness upgrade. Though chaotic in the short term, this event provided valuable lessons in decentralized consensus and paved the way for layered scaling through the Lightning Network. Conversely, a recent example of good news turning sour is FTX's rise to prominence until late 2022. Despite Super Bowl ads, stadium naming rights, and glossy magazine features, FTX ultimately imploded, damaging the industry's legitimacy for years to come. Paradoxically, the seemingly bad news of FTX's collapse will likely benefit the industry long-term by encouraging better Bitcoin custody practices, reducing the systemic risk of custodian failures. Bypassing counterfeits as evidenced by FTX's downfall and subsequent market turmoil, centralized exchanges were never the ideal choice for everyday investors seeking to tap into Bitcoin's vast potential. Bitcoin-linked ETFs, on the other hand, are an even riskier proposition than centralized exchanges. They offer no possibility of withdrawing the underlying asset, Bitcoin itself. This means that holders are unable to leverage Bitcoin's most crucial feature, self-control of their funds without relying on intermediaries. Moreover, there are broader market risks associated with ETFs. ETFs could introduce paper Bitcoin, claims unsupported by actual Bitcoin holdings, potentially distorting the market and undermining Bitcoin's monetary policy. Unlike exchanges like FTX, ETFs may not be subject to withdrawal runs or eventual collapse, allowing the continuous creation of paper Bitcoin. If Bitcoin ETFs become the predominant investment vehicle, the market could become inundated with millions of paper Bitcoins, suppressing Bitcoin's price. With Bitcoin, possession equals ownership in the Bitcoin context. Ownership closely ties to control over cryptographic keys linked to specific Bitcoin addresses. While one may technically own Bitcoin in a legal sense without direct key control, such as through an exchange account or ETF share, this approach is risky in the Bitcoin ecosystem. Bitcoin's digital nature, exceptional portability, and global liquidity make it particularly susceptible to embezzlement, theft, or mismanagement. Genuine Bitcoin ownership hinges on key control. While some may anticipate a short-term price boost with the approval of a major Bitcoin ETF like BlackRock's, the long-term consequences for Bitcoin adoption appear negative, including its long-term price trajectory. True adoption hinges on self-custody, as everything else represents a potential pitfall. Thanks for watching.